Okay, everybody, we are going to get rocking and rolling here. I'm excited to be with you. It has been quite the ride, hasn't it, over the past couple of days and week with the S&P 500. So, first things first, I do want to kind of just I want to review what uh, what position we had on and kind of go through that really briefly, and then we'll quickly jump into how we're going to adjust this and hopefully recoup the majority of our losses and somewhat pull out a profit. So let me just let me pull this up. Let's see here. Okay. Can everybody hear me okay? Loud and clear? Is sound coming in okay? How's the sound? Okay. Let's see here. Awesome. Great. Okay, so our previous position that we had on was we ended up selling the 2100 short call. We had brought in, at least we'd brought in around 75 cents of premium. So we ended up buying that position back yesterday in the 9th hour, in the 11th hour, really, probably the 12th hour. We bought that position back for $2.10. So having brought in 75 cents of premium here, we've got $1.35. So we're under our 2-to-1 risk to reward, which is good. That's kind of the max that we want to see it extend to. We want to keep that loss under 2 times what our premium is at the most. And so we did let this one run just a little bit past the 70% probability, and so our loss was a little bit larger than anticipated in our loss management plan. But we're just trying to let this event go by, but it just, like we said yesterday, it just didn't have any room. It didn't give us any room to see it through that event, and good thing we got out. It was quite the crazy day yesterday. I think we were up, I believe it was Sean that mentioned yesterday, we retraced 18 points, and we retraced again another 18 points, up and down by 18 points, 1, 2, 3 times in just one day. It was quite the day. So, all right, let's go ahead and take a look at our options, no pun intended. We're going to attempt to stay within the same time period that we had before, which is the second Friday in November. So it's going to be that blue line. Now, by way of kind of the thought processes behind how I like to guide my thoughts in adjusting a trade is, number one, beginning with the end in mind. And so for this particular trade, in regards to beginning with the end in mind, remember we've got $1.35 loss right now that we need to attempt to recoup. And so let me pull up just a little note here. Okay, let's see if we can't get this. Okay, so for this particular one, for beginning with the end in mind, we ended up selling our position, and so right now we've got 121,648, I believe. So for this particular trade, what we're interested in here is we need to know what our net liquidity is. So that's the first thing you need to figure out, folks, is what your net liquidity is, because position sizing is the most important thing, one of the most important things in regards to the successful application of this system. So we've got to use less than, no more than 40% of that net liquidity for our position sizing here. And so for this, the way that we'd figure that out is 121,648 by 40. We could use up to 48,600 roughly. But if we can stay below that and accomplish our objectives, that's what we really want to attempt to do here. Okay. So for this one, we also want to know what our loss is. Sorry guys, I'm building the slide as we go. So our losses, or let's just go, our loss was $1.35, and got what, 61 of those. So we'll go $1.35 by 6,100. So we're just, again, beginning with the end in mind. We're trying to determine what we need to bring in to recoup our loss. That's our first objective here, is to recoup that loss. So 82.35. We'll say transactional cost as well. We had, you know, if we can recoup transactional costs, that's great. So we had 61 contracts. I filled this trade twice, right, on the entry and on the exit. And because it's 4 legs, what we'll do here is we'll do 61 contracts times 8. Because we filled 4 legs getting in and 4 legs getting out. So I'm paying a commission on a total of $488 times 65 cents, plus a $6 ticket charge on each, for one for the entry and one for the exit. So I'll add $12 to that. So our transactional cost, our trading fees, $329.20. $29.20. Okay, so that is a loss. Well, those are transactional costs. That was our loss there. So notice here, folks, that my account value, I'm not taking my account value pre-loss. I'm taking my account value post the drawdown, the 82.235. So that is post the drawdown in the portfolio. So now the other thing that I also want to take a look at here is the original credit, because that's kind of my second objective. Is if I can recoup my original credit, I really like to, right? But in making a trade adjustment, our primary objective is to recoup as much as that loss as we possibly can. And not all the time are you recouping the entire thing, but for the most part, we should be able to. And if we can recoup the some of the original credit or profit, that's obviously secondary. Last month, we also had an adjustment in September, and we ended up pulling out around a 1% return on the month, which is, you know, not as great as normal, but it's better than a sharp stick in the eye, a lot better than what a lot of people experience. So our original credit was 75 cents times 61, or we had brought in 75 times 6,100, 45.75. Okay, so if I can recoup that loss, that would be really, or recoup that original profit, that would be really great. But our main objective here is to recoup that loss. Okay, so once we have, once we kind of understand the end of our objective here, our objectives for this adjustment, now we can begin to structure our strategy. So let's go ahead and get into that. Let me actually just move this around just a bit. Okay, there we go. Secondly, is select and master your methods. So we are going to now select the strategy that we are going to use to accomplish our end objectives, right? So let's go ahead and do that. So let's pull this up here. And okay, so the rule of thumb for making an adjustment is that we typically will go back to the options that have around a 90% probability. Okay, we did close out both the put side and the call side of our position. The reason why is because that put side had nothing in it remaining. We had already realized all of the profits. Remember, we had sold, we ended up selling the 1855 strike on our put side. And right now, that put side is going for about 5 cents. So we had locked in really all of the premium that could be had in that put side. It's not benefiting anymore. It's just costing us margin to keep it open. So we close that one out. We're going to take a look here first and foremost at kind of the standard protocol. We're going to sell our options right back at a 90% probability on both sides of this position. So on the call side, 15 days out, the second Friday in November, we'd be looking at selling at 2145 calls. And for the puts, we are looking at the 1985 puts. So let's look at this, just kind of the standard approach. And if we need to make some adaptations, we will do so. Okay, so we've got around 75 cents of premium in that, but let's go take a look at it on the chart here. 2145 and 1985. 2145 is above the all-time highs. John was calling for all-time highs the other day. This is all his fault. All right, and we've got the 1985s down here for our short puts. Take a look at those. I've got really no qualms with either one of these strikes. I feel fairly comfortable just by way of technically. The other thing I want to take a quick look at, which I don't take a look at. Yeah, I know, John, you're an advocate. We need to get back to normal markets, right? Like you always say, good news is good news and bad news is bad. It's been the opposite of that for quite some time now, hasn't it? So, okay. Technically, I've got no problem with my strikes. I do want to take a look at the average true range for the on a 15-day basis. So let's go look at. I'm going to add a study ATR, and I'm going to change this to a 15-day length because we've got about 15 days left until these options would expire. Yep. So right now our average true range over the course of a 15-day period of time is plus or minus about 23 points. Let's go take a look at, I'm sorry, it's around 23 points a day, plus or minus. Oh, wait, hang on a minute here. Yeah, we've got around 23 points. So right now we're pricing in, the options are pricing in a, with the implied volatility, we're pricing in around a plus or minus 50 point move. the upside or the downside. So I want to make sure that we should be definitely outside of that range. So we've got the 2145s and plus 50 points puts us at around 2140. Minus 50 points puts us around 2040. So certainly looks like they are pricing in more risk to the downside than the upside at this point, giving us a little bit more room to the downside outside of that anticipated move. Let's go take a look at where our 70% probability would come in. So this is awesome. This is really appreciate this being shared with us by Richard, or Robert, I'm sorry, Robert, one of our newcomers. Thank you, Robert. I'm going to pull this up. All credits go to him. He created a phenomenal little tool here that is really a great tool to help better figure out your 70% probabilities without having to have your mind explode with doing math. So this is a really neat thing. Let's see here if I've got it readily available. Okay, so what you've got here is, I think, let's see. Okay, so what we'll do, this tool, we'll get this posted in the Tools tab here. I want to integrate it into the Analytics tool as well. But what we'll want to do here is you're going to want to change everything above this this gray cell right here, this kind of bluish grayish cell. You change all this stuff up here, and everything below down here is all automated. It's a really phenomenal tool. And so what you do is you plug in your net liquidity right here. And let's see here, Rich, I'll get your question here in just one second. So net liquidity, I'm going to go ahead and plug that in at 121,648. And today's date, it should actually already put that in there for you. You don't have to change any of that. So enter values from TOS in the gray cell. So today's the expiration date, we're going to do the NOV 2. And so that would be the 11th of, I'm sorry, the 13th of November. So that's 12 days. We are selling, which one are we selling here? We're looking at selling the put at the 1985. The call, we are looking at selling the call at 2145. And we're looking for around 75 cents of premium. It'll automatically calculate your risk. And we're going to go ahead, and all you have to do here, this is awesome. So the current value of the market right now is around 2090. So find the options that have a 70% probability, and this calculator automatically does it for you. So the option on the call side that has a 70% probability is the 2115s. So we're just going to plug in 2115 into that, and then all you have to do is scroll down, find the options on the put side that have a 70% probability. We're looking at the 2055s. All you have to do is plug that in there, 2055s, and now it calculates everything for you. So it will tell you exactly what your 70% alerts are. It'll kind of create an order ticket, exactly what yours should look like. It puts in the quantity, your contracts that you could take on. It's really a phenomenal little tool here that was created. I really, really appreciate the out-of-the-box thinking here by Robert. Okay, so that is fantastic. So what it's suggesting here is that we've got on our put side, if it went down to around 2020, about 35 points down, that's about where we'd have a 70% probability. So let's go ahead and plug that into our chart. That 2020 line I would not be surprised to see the markets kind of quiet down here for just a little bit after the robust action that they've just had. I think we'll probably see a little bit of consolidation action, sideways type movement. And then our call 70% probability alert is about 25 points from the current value, so about 2120. Go up to around 2120. That's about where we would have a 70% probability. Not quite at the all-time highs. So for me, I would probably want to see that confirm that it truly does want to break the all-time highs. So man, I think that that's something that I want to make sure see that we could adjust with this strategy, that our alert is above that that all-time high, which is about 2135. So that's an adaptation that I'd want to make. So all things considered here, I think that I want a little bit more room on that call side here. I want to see if I can't get these calls up just a little bit higher to get this alert. So I'm not chopped out of this trade before it proves to me that it wants to break an all-time high, right? So I really would like to see if I can do that. Again, we're going to attempt to stay within this time period if we can. So let's see here if we can't. I wonder if we could get our. I wonder if we could get up to like the 2155s. Have a little bit of a higher probability on this call side. We may need to pull up our put side just a tad here. Let's go take a look at our chart. So again, the expected move over the next 15 days is around plus or minus 50 points. So 2090 minus 50 points. That puts us down at around 2040. Our alert would be at around 2020. So I would be okay if we had 70% probability coming in around 2040, which is about the expected market move. So I'm going to see if we can't maybe move up this short put strike just a tad to allow our short calls to go up a little bit higher. I wonder if the 1985s, I wonder if the 2005s or the 2000s would give us kind of what we're looking for here. Let us see. Okay, so if we've got the 2115s, okay, so if you're having difficulty there, Hal, setting it to 1080p, what you can do here is just see that little settings icon, Hal? Just click on that, and it should say probably like auto right there. Click on that auto or 360p, and go up and change it to like 720p 60 or 1080p 60, and that should do it for you. If you're in full screen mode, it's the same thing. It's just down there, that little settings icon. Click on that little icon right there, and then go up and change it to the highest quality or 720p HD, one or the other, and that should set the quality there for you, and make that a lot better. So let me know if that solves that. And Rich, I haven't forgot about you, I promise. I'm going to get to that. That's actually on my agenda, is the risk, how much we can risk. So if we were to do the, instead of the standard, if we were to go with the, say the 2155, for our, I'm sorry, 2005 for our put and 2155 for our calls. That's beautiful. Now that puts our, and that would give us, yeah, we're looking for around 75 cents a premium if we can. That's going to give us a 70% alert at 2040 and 2130. So let me, I know I'm going fast. I'll write all this down here, folks. So we're going to move this short call strike up to 2155. I would say don't structure anything yet if you are, just because I'm just walking through alternatives right now. I'm not set in my ways yet. I may even consider going out 1 week or 2 weeks. So now our 70% probability would be at 2140, which is phenomenal. That's exactly where we want it. Up above that all-time high. I would have no problem bringing that down a little bit and maybe bringing that strike price down a little bit. Our short call, we're looking at moving, or a short put, we're looking at moving that one up to 2005. And accordingly, that would put our 70% probability at 2130, which is just below the, oh, I'm sorry, not 2130. It is 2040. Sorry about that. 2040. And I'm sorry, our alert for our short call is also 2130, not 2140. Oh, that's perfect. Okay, so with the expected market move, I'm getting that from right here in the upper right-hand column of our options chain. It's around plus or minus 50 points. If we're expecting around a plus or minus 50 point move over the next 15 days, right now we're trading at 20, we'll call it 2090, and we drop 50 points. That puts us down at 2040. That's right where our 70% probability alert is. That's beautiful. That's perfect. And same thing on the upside. If we were to rally 50 points, that puts us at 2140. I'm okay with this. You know, we're at 2130 for our 70% alert, which is pretty much right at the all-time highs. I think it's going to have a struggle getting above that on a first shot. So awesome, great, Hal, good to hear. So in any case, I really like this position a lot more. Let's go ahead and take a look here at this trade. So the biggest problem here is we're sitting right at kind of our bare minimums. One thing I will look at here is a $10 wide spread. If the $5 wide is just not giving a whole lot, this would reduce the number of contracts I've got to take on. And we're going to keep our risk the same here. It just gives us a little bit more premium. And typically it's, let's see here, we've got around $1.25 of premium here. So that would put us at, let's see here, that would put us at 10 minus $1.25. Sorry guys, I'm just doing some quick math in my head for a $10 wide, so $8.75 of risk. So if I could risk 48.6 divided by 8, let's call it 870, 55. Okay, so the $10 wide 2 weeks out just doesn't make a whole lot of sense. So sorry about that. I just wanted to explore it. Just looking at all my options. Again, step number 2 is selecting your method. Okay, how are you going to best, first of all, recoup that loss if you can. Second of all, recoup any amount of that premium if you can. And so that's kind of the overall objective. So just exploring all my my strategies, all my options here. So I think that this is going to be my best bet here, folks. I don't think that I would do this for any less than 65 cents. I think I'd be a little bit surprised if I actually got 70 cents here. and I don't want to mess with any one of the sides. I think I've got it right where I'd want it, right within the range that I feel kind of comfortable with. So for me, I think that if I'm gonna do it next for 2 weeks from now's expiration, this is what I'm gonna do. So I'm gonna go ahead and take a little screenshot of this thing and pull it over into our notes. And continue on here with this. Okay. So here is kind of the strategy that I'm going to look at. And again, I still haven't ruled out going out another 2 weeks as well, if I had to. Still haven't ruled that out. So keep that in mind. That we may need to do that. So let's go ahead and walk through what we're looking at here. Oh. So what I've got is I am selling a call option at the 2155 strike. I am buying a call option at the 2160. I'm selling a put at the 2005 strike, and I am buying a put at the 2000 strike. Our primary instruments here are our short call and our short put. I will color code those both green and red, as we want the market to stay red. We want it to stop and stay below 2155, and we want it to stay above. So green means go, stay above 2005. We're looking at bringing in a credit here of 70 cents, and we would have a risk of $4.30 associated with that. Okay, so again, our primary objective here is to recoup as much of that loss as we possibly can. And going back to Rich's question, for those of you that that didn't see it, that are in full screen mode, he asked a phenomenal question. He asked, let me just put it on here. He said, general question, with the first Iron Condor we closed yesterday, I had 20% of capital at risk. To recover yesterday's loss and the original premium, I'd be at 60%. To just recover the loss, 40%. Is 60% too risky in this environment? Absolutely. So we scale our adjustments, okay? And the reason is that the market tends to normalize. And this comes from years and years and years of studies. Let me just pull this up for you. Let's see here. Okay. So the market will have these kind of extreme moves, but it doesn't continue to be extreme over and over and over again. It tends to normalize. And so what we learned was from all the data that we gathered through the years was that we could scale into our position, and we learned that it has about a 30% chance that we're going to need to adjust our trade. And after that, the probability that we need to adjust over and over and over again drastically decreases because the S&P tends to balance itself. It starts to normalize. Instead of having these massive fluctuations, it'll start to normalize. And so that's why we're willing to scale into a larger position based on the fact that the chances of us needing to adjust over and over and over and over again drastically decrease. On a first adjustment, we do not, again, do not invest more than 40% of our net liquidity. And it's because on a first adjustment, the odds of a second adjustment are still close to around between 20 and 25% probability that we'll have to adjust again. And so we don't want to be too large and not have the liquidity to adjust a third time if we need to. 60% is our cutoff. If we have to adjust a second time, we could go up to 60%, but no more. If we had to adjust a third time, we don't go more than 60%. A fourth time, we don't go more than 60%. That's the most we've ever had to adjust, was 4 times in a row. But at the end of the day, I'm not so concerned about recouping everything right now, as I am staying under the risk parameters. If I can't recoup everything right now, that's okay. It's okay. Take a look at this, okay? So here, this is showing results going back to just an old spreadsheet of mine that I've used to keep track of my results since 2007. 2007, 2008 are tested months, but they're about as accurate as you can get in a testing environment. But take a look at this. In 2010, 2010 was a really rough year. Low volatility. The market was climbing, very low volatile market. But take a look at this. So we have a 2% drawdown right here. Okay, we adjust it, and that one didn't work out, and we had to adjust it again. And so it immediately gave us on the second adjustment, we had a 12.6% updraw, which completely brought back what our down draw was. And each and every single one of these months, so here in 2010, just to show you specifically here, here's that first month, the first one that we had to get out of. We had that 2.7% or 2.5% drawdown in our portfolio, and then it was followed by another drawdown in the portfolio. But then subsequently we had a beautiful updraw, okay, and it more than compensated for the losses, and it was on a $5 wide spread. So we kept with a $5 wide spread on both of those. But notice here on that second adjustment, that's where we went up to 60% of our net liquidity. On that first adjustment, we went up to just under 40% of our net liquidity. Okay, so in any case, that's something that you want to be very, very strict about, is not getting too ahead of yourself. And take a look at this, guys. You know, that second adjustment, we had to adjust into the next month. We could not tolerate staying within the same series and getting business done. It just wasn't going to work. You know, the first one we were able to stay inside of the same month. The second one we weren't able to. So does that answer your question there, Rich? Really, really great question. Okay, and John gives a nice little disclaimer and notice, and that's really great stuff. Rich says, so if I can add more so for the original premium, that would be a good idea. Yes, almost like betting on a. I said I'm gonna double my man. I guess so, Rich. I wouldn't say that you necessarily need to. certainly don't need to add any more money. I mean, for me, I'm not really concerned about necessarily needing to recoup it all in one shot, as I am staying under the risk parameters and making sure that that we adjust at the appropriate time. So no, I guess you could, but okay. That's right, John. All right. Okay. So moving on here. Yeah, you're right. You're right. You're right, Ray. Yeah, no, absolutely, John. Great comment. If you're new at this, traders trade small. Prove it on a small scale. And also going through the 6-week course, especially in week 6, we're going to get into the details of these years. We'll actually spend the entire week on case studies for all those years and go through step by step what we did, what it looked like, and so you can see it working there as well. So, in any case, I'm bringing in 70 cents of premium here. I'm not really excited about that. Before I decisively go with this one, I actually do want to throw this one over into our Analyze tab and take a look at what our risk would be if it does hit our 70% probability. So I'm going to go ahead and plug that in here, 2130, and we're going to have our bottom side here at 2040. You guys are chatting it up. Sorry, I'm not seeing the chat while I'm doing this. Rich is in the Philippines. It's the middle of the night for him. I'll take a big warm one on the cheek, just like what was it? Jeb Bush said last night. That's awesome. All right, so certainly well within. I've got no problem doing them at 1 p.m. Eastern if that's better for everybody else as well. No problem at all. So this one is great. You know, for next week or 2 weeks from now's expiration, well within our risk parameters. I'm quite pleased with it. I just would be kind of shocked if we actually got 75 cents. I certainly wouldn't do it for any less than 70 cents. It's awesome, Rich. I'm fine with that. I do want to explore, though, real quickly, what it would look like if push this one out to the fourth Friday in November options. Take a look at that. So I'm going to go ahead and queue this order up. I'm going to go save that order. And then I'm going to go and take a look at the options for just 2 more weeks beyond this point. And again, we're going to go with the 90% probabilities initially. And I'll probably adapt that. I do this to bring in a little bit more premium here. The top side would be at 2160. And we'll look to buy the 2165s. So that gives us 75 cents. Obviously, you know, the only reason I would do this is to see if I couldn't get a good amount of premium more. I'm looking at for like $1 or more in premium. So taking a look at those 1940s, it's way down here. Let's see if we can't duplicate this. The fourth Friday in November would be the 20th. So let's put this out there. And so, hang on, the 20th? I'm sorry, the 27th. Sorry about that. I was thinking that looks just like just a week later. Okay, so it's right there. So we would be down here at 1940 and up at 2160. So just to get a good visual look at this, 1940. I'm going to put the longer duration one. I'm going to make that a little bit of a longer line over here. 1940. And our put price, our call price is really about the same. It's 5 points higher at 2160. So that's really interesting. Again, I'm going to make the one that is just 2 weeks further than the first one that we're looking at, just a little bit longer lines. And so I'd be comfortable adapting our bottom side here just a bit. Maybe pulling that up to say like the 1975s, maybe like the 1960s, somewhere around there. Let's go take a look at what those are. The 1960s, yeah, the 1975s have around an 85% probability, so I'd be okay with that. Again, the only reason I would push it out there is to see if I can get a lot more premium here. Look to selling the 1970s. Okay, so that gives us around 90 cents of premium. That's not bad, but when would we have to adjust? So if we sold the 1975s, so if our position looks like this, and we sell the 1975s and sell the 2160s, and we bring in, say, 90 cents of premium here, the current price, we'll call that just 2090 still, I believe. It's trading at 2085 right now. So 25. The short put 70% probability is at 2035. So let's put that in here, 2035, and the short call, 70% probability in that time period would be about 2120. Let's put that in here. So our adjustments are 70% probability for our one that would be just a little bit further out in duration. For the put side, it'd be at around 2025. So again, we'd be pulling this up to 1975. And that would put our adjustment around 2025. So this would be just an 85% probability of expiring out of the money instead of a 90%. And then for our adjustment on the bear call side, it'd put us at around 2025, which is great. That's pretty much right at those all-time highs. I'm okay with that. Sorry guys, there's a lot of lines here. But remember, the ones that are a little bit longer in length are for 4 weeks out instead of 2 weeks out. So let's go throw this one into our risk profile here and just take a quick little gander at what this would look like if we could bring in around 95 cents of premium. So for that one, our 70% probability would be at 2125. And for the bottom side, it'd be about 2025. So yeah, our loss is a lot lower and our reward is a lot greater. I would be surprised if we got 95 cents. But certainly around 85 to 90 cents or so, I think is about fair for this one. Let's see here. So if we brought in 90 cents of premium, that gives us $4.10 of risk. That's the one that I'm thinking I like a little bit better. It gives me less risk if it does need to be adjusted, and our adjustments are actually really close to our other ones. Other than the top side, our adjustment would be about 3 points lower than our current one. It does add 2 weeks to our current cycle. It's the only downside. I was going to look at that next, John. I appreciate you bringing that up. Yeah, it's plus or minus 70 points within that duration. So the odds of us getting touched on one of those adjustments is a lot greater, because right now our adjustment for the second one would be at around 21 or 20, 21.25. And right now, if we're trading at 20.85, that's just 40 points higher. So, yeah, certainly well within the band of that movement. I guess I wouldn't be as concerned with it breaking that all-time high. I think that if I was outside of that 70-point range for our adjustment on the downside, I think I'd be okay with this one. So what's 2084? Yeah, I think we're not quite out of it, are we? A bit about 2015. You know what? It's really close. You know, give or take, probably within about a week, our adjustment level probably is going to be around 2015. So, you know, I actually don't think that that's a bad thing. I would not. I don't have a big problem with. I get the biggest thing is that it adds 2 weeks to our position. So right now, I think the alternatives here are go ahead and just go for the next 2 weeks, recoup just the loss that we've got, and then get back into the normal rotation for the next month. I think that would be a really good one as well. I think that if we could get 75 cents here, I don't know that tacking on, or even 70 cents, it's not that sacred, Ray. It's really close, really close. I mean, you could pull down the 2060 down to 2155 for that 4 week out. I think that'd be okay. The biggest thing I'm looking at here is that, you know, that adjustment level is kind of right on that ledge where I feel like it could go and touch it. You know, I'm kind of in the position, folks, where I almost want to not add the time onto it for the benefit that we're getting. Because here's the bottom line. Taking a look at both of these things back to back together, if I did this first one here, that's even suggesting around 65 cents. Let me just grab this one here, and we'll walk through these two alternatives. Yeah, I don't know that I would. No, I don't think I'd pull it down. I'm sorry, I read it wrong. I don't think I'd pull it down to 2150 there, Ray. Now you're looking at for the one for 2 weeks from now, right? Because at 2150, that's where I would be wondering where my where my adjustment would be. Where would my adjustment be for that 2150 for 2 weeks out? I'm assuming that you're looking at the one for 2 weeks out. It would be, sorry, I've got a lot of options showing here. So 2110, 2150, 40 points. So 2125 is where you'd have that adjustment. Yeah, you know that's not bad. That's fine, Ray. I think that's fine. That's actually not bad at all. Again, I don't think you get 80 cents or so, but 70 cents. It may actually get us a fill at 70 cents. So let's look at that. So let me pull in both of these things here, and we'll kind of look at the outcome in relation to our objective, our begin with the end in mind objective, right? So for these particular two ones, we've got so here is kind of alternative number one. Actually, you know what? Sorry. Yeah, alternative number one, and then let me grab alternative number two. Put that in our note, and we'll kind of just look at both of these in relation to our end in mind objectives and make a decision here. So nothing really changes in regards to the first one here, other than we may look at that 2150 to actually get a fill at 70 cents, 75 cents. But the other alternative is going out 2 more weeks, selling the 2160s, buying the 2165s, selling the 1975s, buying the 1970s. That would give us somewhere around 90, 95 cents. Gives us $4.05 of risk. I think that if I did go out another 2 weeks, I'd probably want to keep my risk a little bit lower than that 40%. Definitely there. Full on crash, right? Yeah, the Russell 2000 tends to be a leader, doesn't it? It tends to lead the market. So we'll see what comes of that. Put our end in mind objectives up here in the upper right hand corner if I can. Let's see if we can't make this puppy work. So we can just see those. Okay, so for that one, if we did our first one here and stayed within 2 weeks, I'd have no problem using the bulk of what I could use in terms of risk capital. If I extended it out, I probably wouldn't want to extend it beyond around 30% of my net liquidity. So that being the case, how close do each of these get us to our objectives here. And again, it's okay not to recoup the entire thing in one full swoop. It's happened plenty of times. It's gonna happen. The objective here is to, kind of do the best that we can to recoup that drawdown and stay within our risk parameters. So that would give us 79.10 of premium. Using 40% of our net liquidity. For the second one, I wouldn't want to use more than probably 30% of my net liquidity, because we are adding time to it, and that there are associated risks with that. So if I were to do that and use no more than, say, 30% of my net lick, let's say 121,648 times 0.3, use no more than say 36. Divided by $4.05, I could take on around, say, 89 of these. So if we took on 89 contracts of the ones 4 weeks out, we could bring in 95 cents. See, I just don't know that it adds that much of a benefit. 84.55. I do like that my risk is a little bit less, but I'm also tacking on another 2 weeks to my position that, and I'm not in love with. I've had to make some adaptations to the position to get the premium that I'm looking for here, and I'm not in love with it. That does recoup our loss, but we'll recoup our loss, either way. I mean, we'll be done with this first position in 2 weeks, and pretty much walk away with close to a scratch. I think we'd be what? We'd have 82.35 minus 79.10, so we'd be, 325 plus transactional cost. So I'd say that's stinking good compared to what a lot of people are experiencing right now, which is just insane chop. I think that I really like that first week, or just 2 weeks out from now, folks. Get in, get out, move on. I think that makes a whole lot of sense. That would just stay. That I'm gonna stay just in the current series here, and do that. I like the levels. I like that my adjustments aren't going to be beyond the expected market move. I really like that my my call side is right up above the all-time high, or pretty much right at it. If it's not up above it, yeah, pretty much right at it. So I think that that's the trade of choice for me, my friends. So gone through a couple of different alternatives. Nothing that we say or do is a recommendation to buy or sell any security. You've got to make your own decisions based on what you see is best for you. But I think that this is one that I'd feel most comfortable with. Here is get in, recoup the bulk of the drawdown for the month, and I think that is a really great thing. We don't proclaim that you recoup the entire drawdown on every adjustment. That's not the case. That is absolutely not the case. Okay, so yeah, 75 cents. Yeah, like I said, not quite sure that it's going to fill us at 75 cents. I think it's going to be closer to around 70 cents is what we're looking at here. So let me go ahead and pull up this risk profile and again, I'm going to be selling the 2155, or I'm sorry, we're going to do the 2150, right? Yeah, I would look for around 70 cents a premium on that. So we're looking at selling the 2150 and selling the 2005. Looking to pick up around 70 cents a premium here. We're currently trading around 2085. Our 70%. Let's just make sure that we've got that right. Our 70%, the options have a 70% probability of expiring out of the money. For 2 weeks out would be the 2110 on that call side. So let's go ahead and put that in there, 2110. And on the put side, we're looking at around 2050. So our adjustment levels, just to make sure that we've got them right here, would be 19. Sorry. Put something wrong in here. We've got the 2005s, 55s. We're looking at the 2050s for 70% probability on the put side, and the 2110s on that side. So let's see here. I think that sorry, I'm using this calculator. I think that there's a little bit of a mistake, so I'll just do this by hand. So for the 2005s, 2050s, we're looking at a 45% drop. That's 45, puts us around 2040. So I want to make sure that we've got that right. Yep, we're good there. And then the top side, just make sure that we've got the right orders there. 2110, 2150, that's 40 points. So 2080, 5 plus 40 points, 21 quarter. So it puts that just slightly down. Okay. So 21 quarter, 2040. Let's put all that into our risk profile here. And bada bang, bada boom. Close to a 1-to-1. Again, we want to make sure that we keep that under definitely no more than 2-to-1. So we're looking at around about an 80-cent loss there. Yeah, I don't think that they're filling here for around 70 cents. But yeah, I don't think that they're filling quite right now at 70 cents. Maybe they are. Yeah, we changed it to the 2150s. There might be. We've got 2 weeks out. Yeah. Okay, so let me go ahead and grab this and let's fill out our log here. Okay, so we're looking at the S&P 500, same expiration date as last, November 13th. Looking at selling the 2150s, buying those 2155s, looking at selling the 2005s and buying the 2000s. That's going to give us around, we're looking for around 70 cents of premium here. Okay. And so that would give us $4.30 of risk. So we've got 70 by 430. That gives a 16.2% return on our invested capital in 15 days. Okay, so in regards to our position management plan, two parts: profit management, loss management. Profit management will likely just let these things expire worthless if we can. Would look to limit our losses to no more than about, I would say, around 85 cents. Don't see a whole lot of need to push it much further than that. The top side is going to have around 80 cents, the bottom side around 45. We observed that the risk profile on TOS, so we would have around an 80 cent loss if the short call strike went to a 70% probability, which as of today, that would be around 21.25. That number does increase as time goes on. Also, we would have around a 46 cent loss if the short put strike went to a 70% probability, which would occur around that 2040 price level as of today. Okay. So I think that, let's see here. Yeah, looks like they're filling them at around 65, 75 cents or 70 cents. So, yeah, I think all is good here, folks. So I want to just go quickly here, and we'll get in depth into next week. But I do want to cover just briefly something that we've already done here. In putting this whole thing together. Let's see. But the final part of all of this, folks, after you've come in here and effectively determined your strategy, how you're going to accomplish your objectives, once you've figured out kind of what your overall objectives are and figured out kind of a strategy to accomplish that, the final thing that you've got to do is both plan and prepare for the worst, and also identify and utilize those co-pilots. Be active in the community, share kind of what it is that you're looking at. there's no place for the whole guru mentality. There's just no place for it. We've got to have a community that is humble and open to interdependence and collaboration, because we're all stronger as a whole instead of dependent on a one. And so my voice is no more louder than yours. I'm the one that happens to be hosting it, but your ideas, your thoughts, your input is critical. So in any case, we've planned and prepared. We've gone through. We've figured out exactly where we would need to adjust this position if we do need to. And we've figured out our alerts. We're going to want to make sure that we set alerts on those. So first thing you need to do before you walk away, set alerts for those areas where you'd have around a 70% probability. If they're chimed, don't panic, okay? It's going to happen. Get used to it. It's okay. It's just now time to pay attention and get to work like we've done over the past couple of days. It's been a little bit more strenuous over the past couple of days, but you don't need to sit around and necessarily watch it all day long either. It's in any case, set those alerts, make sure that those are set, and you're in a good spot. So in any case, yeah, Angie, we did. We put it down. We put the 21. Our short calls are down there at that 21.50 strike. Did I mess that up? Looks like I got 21.50 in here. Oh, I think what you're referencing, Angie, was this slide right here. Select and master your method. I think that's what you're referencing, huh? Okay. Yeah, on the actual note here, I've got it written out. So, yeah. Okay. So today, this afternoon at 5 p.m. Eastern time, we're going to be getting into the things that we do pre-entering this position. It's not rocket science for most of you, but it's going to be a good refresher. And there's going to be a workbook along with it that you'll begin to be able to have for when you do this on a monthly basis, and be able to go through this entire process. Not just this keeping of the notes, but also a workbook where you'll be able to go through and write down what we kind of just did right here for each phase of this particular position. You'll be able to go through and kind of walk through that beginning with the end in mind, and you know, kind of putting all that stuff together instead of just this trade log. So I haven't had any fill yet. Yeah, they're still looking like they're filling at around 60 to 75 cents, or 60 to 70 cents rather. So that's all. Again, contract quantity, we don't risk more than 40% of our net liquidity. So the way that I figure that out is I come over here and I figure if I'm bringing in 70 cents of premium here, and I could use up to 40%, but no more, then what I would do is I would take the, you know, what I could use, so say 48.60, and divide that by my risk of 430. And we've got this calculator. We'll get this to everybody in time for the next trade that we put on, but that's what would help me determine the number of contracts. So again, I think that I would loudly echo what John said. Scale into this, guys. Learn it. Get comfortable with it. This is a really, really great couple of months because we can go a year without ever seeing an adjustment. And you don't learn anything in those times. It's quiet, it's boring, there's not a whole lot to do. but we'll hopefully be able to synthetically create that environment throughout the 6-week training in the passive course, especially with week 6, where we'll go through all the different years starting back at 2008 and go through all those different circumstances that went against us and how we're dealing with that. So anyways, any questions today? Any questions? All makes sense? Again, we've got that class this afternoon starting at 5 p.m. Eastern Time. It will be dealing with the pre-entry process for the passive approach. Yeah, certainly can do that, John. We try to keep a large portion in cash. Alrighty. Well, we're going to go ahead and wrap up, guys. We went a little bit over an hour, about an hour and 20 minutes. That's about as much work as this thing takes. We went through a lot of alternatives here. Really like this position. If we can get a fill, we'll pay attention to it. But hope you guys got something out of this today. We'll see as many of you as we can tonight in the pre-entry class of week 3 of our passive approach. And as always, until next time, trade super.